talk about inventory. All right. First of all, let me give you some review on what we had last week. All right, inventory. For service companies, there's generally no inventory. All right, service companies, they provide their services. There's generally no goods or products to be purchased and sell them. So they sell their knowledge, their knowledge, their maybe labor, okay, not the products. There's no inventory. So on their financial statements, there's no inventory items reported. But for merchandise company and manufacturing companies, they report inventory. For merchandising, it's simpler. Generally, one item inventory is reported. Okay? And how about manufacturing company? There are more items for manufacturing companies. Generally include raw materials. What else? Haley, what else? People got it already? Students. Finished goods, yeah. But what about those are not finished yet? It's work in process. Work in process. Okay? An inventory is recorded in the current asset. And it's generally a very important items for merchandise company or manufacturing company. Because inventory is generally the source of the revenue. Okay. If inventory is not reported correctly, then it's gonna affect cost of the sold. Okay. So once cost of the sold is affected, net income will be affected. All right. So that's why it's important to make sure that inventory is reported correctly. So what should be included in the inventory? What should not be included in the inventory? So these are the issues that we need to make clear. Okay, in this chapter, it provides some issues to help us to clear about inventory. Okay, let's see. To clear about inventory, this diagram is also important. So I want you to be clear about this one. All right. Inventory can be beginning inventory or end inventory, right? So the beginning inventory comes from the end inventory. If you know the closing process, okay? So during the at the end of period, we will do the closing, right?
Yes.
So when we do closing, how do you deal with the different kinds of the accounts? Generally, two categories of accounts are divided. Okay, one is temporary account, the other is permanent account. Okay, so what are the temporary accounts?
Temporary.
The revenues and expense accounts are temporary accounts. So they should be closed at the end of the period because we want to calculate the operating result, right? So we use only revenues and expenses. Okay, if revenues are greater than total expenses, there will be a net profit. On the contrary, there will be a net loss. Is it right? once we calculate the operating result, we close the accounts to 0. Remember that? Yeah, so the temporary accounts are closed at the end of the period. For those permanent accounts, yeah, permanent accounts include asset accounts, liability accounts, and equity accounts. So they are not closed at the end of the period. So the balances of these accounts are transferred to next period as beginning balances. Okay? For those temporary accounts, they start with 0. All right? So inventory is one of the permanent account. All right? Inventory is an asset account. All right? So at the end, what's left in this inventory, it becomes ending inventory. And the balance will be transferred to beginning inventory. Right? Right. So once you have beginning inventory, you will try to sell the inventory. Right? And at the same time, then you purchase some more products in. Right? So company will try to keep the inventory label at a certain label, just in case you don't want to encounter the case that when customer come to make purchases, okay, then you don't have inventory for the customer, right? So the companies always try to keep inventory at a certain level to meet the requirement of the customers, right? So, so companies will purchase goods. So those costs will stay in inventory as well, right? So you have beginning inventory plus the goods purchase in the current period. So both together is the cost of goods available for sale, right? And in the current period, then company will try to make sales, right? So for those inventories, if they are sold, and the cost will move to cost of goods here. You understand?
Yes.
And what is left will stay in the inventory. And at the end of the period, we call it as ending inventory. And it repeats again, right? It's not closed, so it will transfer to beginning inventory. Yes. And how about this one? Cost of sale. It's a temporary account or permanent account. It's a temporary account. So it will be closed at the end of the month of the period, right? So it is closed. So everything, the accounts, the balance will start over with 0, right? So that's how the inventory cost flows. Okay. So this inventory, if there is a mistake, and the cost of the sold will be affected. And that's next, gross profit will be also affected. So do you know how do you get gross profit? Not sure? How do you get gross profit? Not sure. I forgot. Okay, it is quite important concept, so I can do a little bit more review. Yes. Yeah. The gross profit, right? We're talking about gross profit. So you make sales. You make sales. Right? But let me put it this way. You make sales, so you recognize sales revenue. the cost, the inventory cost will move from, the inventory to cost of goods sold. Yes, so sales minus cost of goods sold. And then it comes to gross profit. Does that make sense? Okay. And gross profit is only the sales minus the product cost. But for a company to sell products, there are different kind of expenses would incur to support the sales. Does that make sense? Such as what kind of expenses might incur to support the sales? Marketing, marketing expenses, or admin expenses, right? Okay. How about marketing expenses? What kind of marketing expenses? Maybe advertising, ads, or sales representatives can be also a part of the marketing and selling expenses. And admin, like accountant salaries can be utilities, can be admin expenses, right? So we call those expenses as period costs. Period costs minus, we call those period costs, including you say marketing, selling, and administrative, all this kind of costs to support the sales. And even if there is an income tax, that will be also deducted. And then come to, let me put income tax as well. And then we'll go to net income or net loss. Okay? And here I want to add one more word here. Net sales. So what is the difference between sales and net sales? Do you know? Really? Not sure. Okay. Most of the time, if there's no net, if you see sales, that would generally mean gross sales. And net sales means that after deduct sales returns, sales discounts, or sales allowances. So sales returns, right? Yeah. So when you make sales, sometimes customer might return the product, the goods back to you. Right? And discounts is the it's more about what is that? We call that how we call that the word. Company try to make the customer to pay cash, quickly, and provide the cash discounts to customers. So we put it as a sales discount, okay? And allowances generally is customer might complain about the product, but it's only small flaw of the product. It's still useful, okay? And if the company might tell the customer say that, well, you keep it, but I give you an allowances. Okay, so if the product is like $5,000, okay, I'll give you $100 allowances. And the customer might be happy about that and keep the product. So that is an allowances, okay? So the net sales would deduct returns, discount, and allowances. All right? How about cost of goods sold? How do we decide cost of goods sold? Cost of goods sold. Yeah. If you look at the diagram, so yeah, you can cost of goods sold comes from, of course, under perpetual inventory system. What you can get cost of goods sold from the account. You can always check the account balances for cost of goods sold. But if you want to do calculation, you can cost of goods sold from beginning balance, right? Plus net purchase in the current period, and minus ending inventory. And that would be cost of goods sold. Does that make sense? I hope. So, see, this, if you call it as formula, that is okay. So, these items, if you look at the diagram, beginning inventory, right? Plus what is purchased in the current period. Okay? Together, these two is the total cost of goods available for sale. Right? And at the end of period, what is left will stay in the inventory. What is gone will move to cost of goods sold. Right? So if you put this into this way, it's the same, isn't it? Yeah, now you are doing business, so you should have the concept.
Yes.
Yeah,
On the operation.
yeah. And see, yeah. So that makes more sense?
Yes.
Okay.
Look, I know about this, but the
Not sure about
formula,
this.
yeah.
Yeah. Okay. All right. So now I want you to look into this word, net purchase. So the same here. When you purchase products in, sometimes you are not satisfied with the products, right? Then you may return the products. So there will be what was that? Purchase returns, right? And sometimes you may pay cash early, so you may get cash discount. So it's purchase discount. And also you might get allowances for the purchases. Alright? So that's what we call net purchase. Alright? So net purchase, but there is one more you need to know is anything. Any costs related to the purchase, okay, to make the goods ready to sell. So any costs related to can be a part of the inventory cost. For example, transportation cost. If you purchase, let's say, PV, okay? So if you purchase PV, right, and then you have to pay the transportation cost. So that transportation cost is also a part of the inventory cost, right? And if you need to pay insurance during the transportation, so that is a necessary cost. So it's still a part of the inventory cost, right? So, and what else? Even with the taxes, if the taxes are not refundable, and they can be, included in the purchase and become a part of inventory cost. So we call it net purchase. So net purchase can be a deduction, can be an addition to the cost. You know what I mean? Yeah, very good. All right. So that's generally, that's how you get cost of goods sold. All right. So the net sales minus cost of goods sold is the gross profit. Okay. If I put some numbers in to help you understand the concept. Good? Okay, let's see. All right. Let's put it easier. TV, okay? All right, so total, the company in October sold, let's say 10 TV, okay? So each one, TV sold. Okay, let's put it easier. Let's say, each one is sold at $20. Okay, so 10 TV times 20. So the sale is total is 200, right? So this 20 is the selling price. Okay, and cost of goods sold. Let's say average. Okay, we use average cost. All right, average is let's say 120. All right, 120. All right. So the cost of goods sold for each one is 120 since 10, right? So the cost is to 20. What I said? I'm sorry. Not 20, 120. 12. I'm sorry. 12. So that makes it 120. So you use this. So I'm talking about the sales figure. I'm talking here. Okay, let's apply some returns. Okay, let's say one customer is not satisfied with one TV. Okay, so the customer decides to return this one TV. All right, so therefore there is a returns one TV. So of course you need to return $200. All right, and let's say there's a discount as well. Okay, a company-wide discount. Let's say $5. All right, so net sales equals how much?
That's 20.
This would be 20, right?
Yeah.
Okay, and how much is going to be? 175. Net sales. All right? And one TV is returned. Therefore, cost of goods sold should be taken up. Right? So cost of goods sold, instead of 120, now because the cost is 12, so you need to deduct 12.
108.
Huh? Why?
108.
Why not?
108. I'm in summations of it. 120 deducted by 12.
And how much is that?
108.
108, yeah. Yeah, you're right, 108, yes. So the gross profit will be, how much is that? 67? Is it? 175 minus 108, 67. Okay, now let's assume there are period costs. Total $50. Okay, and income tax $5. Assuming, okay. And then you should have a net income of how much? 67. 27, 27, 22. It's easy, isn't it? Okay, well, actually, I prepared exercise, yeah, I think it's the right time for you to do some, exercise.